Welcome to an essential topic in financial management, capital budgeting. Today, we'll focus on the payback period. Capital budgeting is the process a business uses to evaluate major projects or investments, such as new machinery, buildings, or research and development. The main goal of capital budgeting evaluation is to determine whether a project's potential returns justify its cost and risk, ensuring the business makes value-maximizing investment decisions. Evaluation methods fall into categories like discounted cash flow techniques, such as net present value, and non-discounted methods, like the focus of today, the payback period. Let's define the core concept. The payback period is a crucial tool in capital budgeting used for project evaluation. Simply put, the payback period measures the time required for a company to recoup the initial investment in a project from its net cash inflows. In decision-making, if the calculated payback period is shorter than a company's predetermined maximum acceptable period, the project is accepted. Otherwise, it is rejected. Now, how do we actually calculate this important metric? The calculation depends on whether the project generates equal or unequal annual cash flows. If the annual cash inflows are equal, the formula is straightforward. Divide the initial investment by the constant annual cash flow. For unequal cash flows, you must accumulate the cash inflows year by year until the cumulative amount equals the initial investment. This often requires interpolation for the final fractional year. Despite its simplicity, the payback period offers several clear advantages for initial project screening. Its most significant advantage is its simplicity. It's incredibly easy to calculate and understand, making it accessible even to non-financial managers. The payback period strongly emphasizes liquidity and risk. A shorter payback period means faster recovery of invested capital, reducing the project's exposure to risk. However, the method has significant limitations that must be acknowledged, especially when compared to more sophisticated evaluation tools. A major drawback is that it completely ignores the time value of money, treating a dollar received today the same as a dollar received 5 years from now, which is financially unsound. Crucially, it ignores any cash flows generated after the initial investment has been recovered. A project could generate huge profits later, but this method won't capture that value. In conclusion, the payback period is a simple and effective measure of liquidity and quick risk assessment. While limited by ignoring the time value of money and late cash flows, its best use is as a preliminary screening tool to filter out highly illiquid projects before moving on to discounted cash flow analysis.